Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, drop it a like and hit subscribe. But for now, let's get into it. So today we're going to talk about 3 reasons why I would consider selling out of a stock. It's often said by Warren Buffett especially that the longest or the ideal holding time for an investment is forever. But as a smaller, nimble investor, new opportunities come up, prices move around, and we need to have a good strategy in place for when we eventually do need to sell out of a position. So the first reason why you might want to sell out of a stock is that the price becomes greater than the value. So my fundamental strategy is value investing. What that essentially means is I analyze a business, I come up with what I think that business is worth, so I value the business, and I buy it if the price in the market of that business is dramatically less than what I believe the value to be. So if that's my buying strategy, my selling strategy is essentially the opposite of that. So if price exceeds the value, if for example I value a company at $100 a share, that means I'm going to generally be buying it at anything less than about $50 per share. So by default, I'm looking for at least a 100% upside before I sell out of this investment. Typically, this is going to take a few years to actually kind of happen unless we see quite a quick correction in that stock price. So it's going to take time to move from 50 to up to 100 or near 100, assuming that even if I'm correct in my evaluation of the company. And when it gets to 100, that's when I'm looking to sell out. So there's a couple of fundamental reasons behind that. Number one, it's my strategy. I believe the company's worth 100, so if I'm going to get a return that's greater than the market, I'm going to have to buy it for less than 100. Even if the company is quite quickly growing, you're not necessarily going to see a rapid rate of return if you're buying it at fair value. So that's the first reason why I might sell out. There's some investors that have sort of different philosophies around this. So people like Guy Spear, for example. If you don't know who Guy Spear is, you should definitely check him out. Really good value investor, and wrote a book called The Education of a Value Investor as well. So Guy's rule is typically to start selling out at anything around about 80% of intrinsic value. There's going to be some ranges here. Personally, for me, I like to get a little bit closer to intrinsic value. So say within sort of 10%, I'm going to start selling out. And if this price gets greater than 20% over intrinsic value, so in this example, if this were at $120, I'd be out in a second. I'd be out straight away if it was at that. In my books, that's overvalued at that point, and I'm speculating rather than investing. So that's number one. Let's get on to point number 2. The second reason why I might consider selling out of a stock is if the company is no longer wonderful. So I'm going to leave a bit of a description in the description box below around how I define a wonderful company with some sort of practical examples. So if I miss anything in the video, it'll definitely be down in the description box, so go have a read of that. But essentially I use the 4 M's from Phil Town, and when I'm assessing the wonderfulness of a company, I'm essentially looking at those first 3 M's. So I've run through some of these before, but I'll quickly jot them down. So the first one is around meaning. Basically, meaning is all about whether or not you're capable of understanding the business. So if you're investing in quite a simple business, which I hope you are, because then you'll have a high chance of understanding it quite well. Let's take Coca-Cola as an example. They have a pretty simple business model. They make soft drinks and they sell soft drinks. They have a few other beverages, but that's their fundamental business model. So if I was invested in Coca-Cola, for me to have to get out of that investment due to the company no longer being wonderful and me not being able to understand it, that would essentially mean them getting into some sort of big new venture that was completely over my head. If Coca-Cola started getting into blockchain technology and biopharmaceutical science and all sorts of stuff like that, Well, that's way over my head. It's a fundamental change in the strategy of the business, and it means that I no longer understand the business as well as I did before. So, meaning if I no longer understand the business, if it doesn't mean anything to me, if I don't care about the industry, I'm going to sell that stock. Oftentimes this isn't going to change a huge amount, but if it does, that's a reason why I might want to sell. So that's number one. The second one is a big one, so that is around moat. So a moat is an intrinsic characteristic of a company that gives it a competitive advantage. And there's a few different types of moats. Again, I'm going to list some examples in the description, but a moat, again, let's use the Coca-Cola example, would be something like a brand. You're also going to have brands with things like Apple, various other brands out there, you guys know plenty of them. That gives people like Coca-Cola and Apple an advantage in the marketplace. So they actually have the ability to sell at a lot higher prices than their competitors. So if you're buying a budget brand or a name brand cola drink from a shop, that's going to be a lot cheaper than Coca-Cola. They simply can't charge as much because nobody recognizes the brand, and that brand doesn't have the reputation for quality that something like Coca-Cola does. There's other types of brands, so there's other types of moats. So something like a toll bridge moat is something that is generally really strong. So a situation where you have to use that company to get the product or service that you're after, that's a massive moat. So Burlington Northern Railway have a huge moat. If you want to compete with Burlington Northern, you've got to build your own railway. That's very expensive, it takes years, it just doesn't make financial sense, and you're not going to slap a railroad up right next to the Burlington Northern one and attempt to compete. Just doesn't make a lot of sense. So that's a moat. If the moat gets breached, we want to get out. So a good example of this, and a company that I want you guys to go and have a look at their stock chart actually, is a company called BlackBerry. So you guys may remember BlackBerry. They were very popular phones in sort of the early part of the first decade of the 2000s. Phones with keypads on them, if you don't remember them. I'm sure you do though. So go look at the BlackBerry stock chart. That's an example of a brand that was breached, a moat that was breached by another brand. So in the case of BlackBerry, BlackBerry was completely destroyed by the iPhone. So that's an example of a moat that's been breached. This is why I'm often really wary of investing in technology companies. New technologies can come out and disrupt moats, and they can basically ruin the business model of a lot of companies. So I tend to steer clear of technology companies for the most part. Doesn't mean I'm completely against them or anything like that. I'll invest in them if I do think they have a durable moat. But in short, if the moat's breached, I'm going to get out. So that's first two M's. The third M, if I can clear a little bit of space here. So the third M is management. And management, pretty self-explanatory. Are the managers of the business doing a good job? So there's two sort of main criteria here. Do they have integrity and do they have talent? So are they running the business effectively and generating high returns? So an example of a time that I might want to sell a stock due to management would be if I don't think the management has integrity and they're not people I want to be associated with any longer. Really good example of this is a company like Lululemon. So if you guys are familiar with Lululemon, I have a lot of males that watch my videos, so you may or may not be, but essentially Lululemon make yoga pants, and their CEO a couple of years back came out and said that, well, he was questioned why Lululemon don't make sizes of yoga pants above, I think it was a size 12 from memory, and essentially he said they don't want people bigger than a size 12 wearing their clothes. So that's not a guy I want to be associated with. So that's an example of a company that I'd be selling out of if I heard something like that. The second thing around management is actually about performance. So there's two things I'm really looking at there. So I'm looking at what returns are they generating. So that's going to be a number called ROIC, so return on invested capital, of the investments that they're making into the business, what percentage return are they getting. And for ROIC, I'm looking for generally at least a 10% return on invested capital. So if I see that dip below 10%, it's a pretty fundamental reason why I'm going to be kind of getting out. Another number you might want to look at here is return on equity. Again, we want that to be greater than 10%. Basically, it's exactly the same as return on invested capital, only this is looking at just the equity portion of the capital. So if the company's taking out debt to invest into the business, that's going to inflate the return on equity, and you'll see the performance on the total capital that they're investing, so equity plus debt, and the return on invested capital. So those are a couple of the things I'm going to look at. The other one is around debt. So if I see that a management is letting a company's debt levels get out of hand, that's also a reason I'm going to sell. So let's get into number 3, final reason why you might want to sell a stock. Third and final reason why you might want to sell, stick around to the end for this one. We want to hack that YouTube algorithm. I've been watching Graham Stephan's videos, so stick with me on that one. Hit like, subscribe, comment if you haven't already. So third and final point why you might sell a stock is basically better opportunities. So essentially, this one's pretty self-explanatory as well. Hope I've got opportunities right there. If I haven't, let me know. So at the end of the day, when we're investing in the stock market, we want our money to be working as hard as it possibly can for us at any point in time. So we want it to be generating the highest returns possible with the lowest risk possible. And from a value investing strategy, that basically comes down to one fundamental thing, which is margin of safety. So if we're buying $1 and we want to buy it for 50 cents or less, we've got a much larger margin of safety the lower this price is relative to the value. So if we're able to buy something for 40 cents or 30 cents, there's a much lower likelihood of that investment going down over time. So that gives us lower risk. And when it does correct eventually to that $1 value, or in and around that $1 value, that's going to generate a much higher return if we buy it at a bigger discount or a bigger margin of safety to that price. So what I mean by better opportunities and when you might actually want to sell a stock because of margin of safety, essentially I mean this. So if I, just like in the first example, if I buy something for $50 and I think it's worth $100, and then that goes up to $90, I've got now a much smaller margin of safety. I'm within 10% of the intrinsic value of $100. So what that does is it lowers my potential returns, and it increases my risk or potential downside. So as we approach intrinsic value, as we see opportunities out there with a larger margin of safety, that's a great time to be selling and a great time to be pushing into new investments that can continue to generate really high returns. So that's number 3. The only other consideration you might want to make in this example is around things like tax implications. So if you get into an investment that corrects up to intrinsic value really quickly, so say within 12 months, in the United States there's going to be different tax laws depending on the amount of time that you hold that investment. So if you hold it for less than 12 months and sell, then you're going to be taxed on the gains at your typical sort of income tax rate. If you hold it for longer than 12 months, the tax rate that you get charged on those gains drops right down. So that's a consideration you may want to consider here. But outside of that, if there's a better opportunity, go get it. Within 10% of intrinsic value, that's within margin of error, not margin of safety, as Lee Lu would put it. If you haven't seen Lee Lu's lecture on margin safety, go check it out. Highly recommend. But that's my top 3 reasons. So I hope you enjoyed that. If you did, drop me a like, give me a comment, and I look forward to seeing you in the next video. Cheers.